Now, the purchasing of a call, let's go back to purchasing of options. The purchasing of a call means to have a bullish expectation. The purchasing of a put means to have a bearish expectation. So what if we know that a stock is going to release the communication about the earnings of the last quarter, and we expect that the price is going to move significantly, but we cannot predict the direction? How could we take advantage of options in order to have the chance to gain no matter where the underlying goes, but we just needed to move significantly in one of the two directions? We could combine at the same time the purchasing of a put and the purchasing of a call. But of course, the higher the expectation about the price move due to the earnings, the higher will be the prices of the options. So the higher will be the premium we pay to purchase both at the same time. And this will have a disadvantage, which will be that the break-even points will be quite far from the current price of the underlying. But if our expectation is correct and the price moves significantly in the moment that the earnings are released to the market, maybe we can get a very interesting profit. Let's try and make an example. The price of the underlying, referring to yesterday's close, is 39.69. So the at the money options, both calls and puts, are these ones. The call is 150, 153. The put is 128, 130. So if we purchased both yesterday on close, we would have paid 153 and 130. Let's see what does this mean. We are creating a new strategy on stock USA. We are purchasing a call, strike 39.50, paying 153. And let's add another instrument, which is a put. Long, same strike, the premium, I don't remember, is 130, and close the strategy. What happens is this. We have a V payoff, we have a maximum potential loss in the strike price. If at maturity the spot price is exactly equal to 39.50, we will lose all the premium paid, 153 on the put, on the call, 130 on the put. It means 2.83 per shares, that is $283. The break-even points will be 39.50 minus the total premium and plus the total premium. So the total premium is 283. So the break-even points will be a bit below 37, about 36.6, and in 42.6. And then we will gain proportionally to the price drop or the price increase. Should we be right about the expectation of a strong movement, but who knows the direction, we will gain quite a good money amount. And this is a way to take advantage of expectations of strong movements, no matter the direction. Could we reduce the maximum risk by doing something different? Yes. We could offset the strikes of the call and the put. For example, purchasing a call 40 and a put 39, about $0.50 out of the money in both directions. Let's see what could this mean. If we purchase the put 39, we would pay 1.08 instead of 130. If we purchase the call 40 instead of the 39.50, we would pay 127 instead of 153. What would this mean in terms of the payoff? 127, 108. Let's overlay the two payoffs. The call this time is 40. The premium paid is 127. Let's add another instrument, which is the put. Strike 39. The premium is 108. Let's close the strategy and let's compare the payoffs. Here we go. I definitely have to fix this because this should be an horizontal line and not a broken line. I have to fix this. I will do it. Anyway, what happens is that we have a reduced maximum potential loss. 127 plus 108 means 235 instead of 283. But with the long straddle, the strategy made of a long call and put, same maturity, same strike, long straddle, the V. With the long straddle, we would have a maximum potential loss in one single point, the strike of the two options. Purchasing the long strangle, which is the red line, the strategy made of the offsetting of the strikes of the call and the put in respect with the current value of the underlying, would lead us to a lower risk in case we make a mistake, but that risk would be the same no matter the price of the underlying between the two strike prices. So for any price between 39 and 40, we would lose all the money paid for the strategy. And basically the payoff would be more or less the same. So we would have more or less the same gains no matter the direction of the underlying, but we just needed to move significantly in one of the two sides.